Welcome to the Big Technology Podcast Friday edition, where we break down the news in cool and nuanced format, looking at what happened in the week in tech this week. Well, we definitely have a big story to dig into, and usually we cover a bunch on this show, but today we're going to dedicate it just to one. It's really an emergency podcast because as we speak, there's currently a run going on Silicon Valley Bank. I don't think there's any other word to use for it, and that's what's happening now. They are trying to sell themselves, and by the time you're listening, they might either be sold or, who knows, possibly worse. And this is definitely a complicated question, one that deserves a breakdown with nuance from experts and people following the story, and that's what we have for you today. Joining us today is Dan Primack. He is the business editor at Axios, one of my favorite reads. He writes the Pro Rata newsletter. And as always on Fridays, we have Ranjan Roy of Margins.
Hello.
Welcome, Ranjan. Welcome, Dan.
Hey.
So where does this rate on the crazy scale in terms of financial stories?
I mean, to me, this is extraordinary. I mean, I woke up yesterday being Thursday, and Silicon Valley Bank announced that they were going to do this share sale. They were going to try to raise a little over $2 billion to kind of firm up their balance sheet. They had some issues, kind of some of their treasury investments kind of went sideways, but it didn't look good, but it looked like, okay, company trying to right itself a little bit. We're 24 hours later, and we're talking about them being for sale, and not for sale like, hey, we're hoping to get a good price. Like, please, somebody, please buy us and put us out of our misery immediately. It's extraordinary. And within Silicon Valley, for those who don't know SVB, it is the largest lender to tech startups, to life sciences startups. It's where lots of venture capital funds put their own money. It's a really big deal. It's the 16th largest bank in the entire country.
Okay, yeah, and let's go there because I feel like we should really start talking about what this is so we have an understanding of what the significance is. And I think for a lot of our listeners, they're going to be familiar with Silicon Valley Bank. But for those who aren't familiar, why does the tech sector have its own bank? At least that's the way that a lot of people view it. Why not just a normal bank?
I mean, that's a very good question. I mean, for starters, SVB has been around a while, mainly because it was one of the first banks that went after tech clients, right? Particularly tech startups that were really small, right? If you're a big bank, you didn't necessarily want the account of a company that had maybe, $500,000 at best, maybe $1 million. Go back right before the average venture capital round was 10, 20, 30 million, when they were raising, $500,000, that's $2-3 million Series A round. They really went after these companies and embedded themselves in the ecosystem. I mean, they're not alone. There are other banks out there and even some big ones, right? Chase, which is part of JP Morgan, has been a major player in Silicon Valley. But SVB has been a really big deal. And it's also been a place over the years where they've gotten into wealth management. So then founders, venture capitalists, et cetera, put their own money in there. And they've gotten very big and they're big in venture lending, which when we think of venture capital, it's usually equity, but they're also companies sometimes raise debt. And SVB has been a major player, kind of a groundbreaking player in that.
Wait, so can you talk a little bit about the trajectory of Silicon Valley Bank? Because, I mean, I'd seen that total deposits had risen 86% in 2021. So, I mean, was this a pretty straightforward operation for a long time and then just got caught in the everything bubble along with everyone else? Or...
Yeah, but when we think of the everything bubble, it wasn't so much that Silicon Valley Bank was trying. I mean, obviously, every bank wants to get bigger, but it was really a byproduct of what was happening in the venture capital market, right? If companies go from raising, 20, 30, $40 million in a Series C round, for example, to going to raise 100 or 200 in the Series C round, and they're using SVB as their bank, well, the deposits are getting a lot bigger, right? The rounds get bigger, the deposits get bigger. If the companies do well and their revenue starts to go up, obviously that increases the deposits as well. So SVB, yeah, it was part of the bubble. And it also did start offering very, very good incentives for people to take out credit lines, et cetera. Very, very good rates.
And it also had didn't it do some more risky investing? And I know that's not the problem right now, but let's just talk about it quickly, that it invested in some crypto and it used pre-IPO shares as part of its collateral. Do you guys have any sense as to how it operated differently in that sense? Because it did seem like it had a greater tolerance for risk than maybe your typical bank. Or am I reading that wrong?
I honestly, I don't want to speak too much out of school on that because I'm not exactly sure, except to say that seems to be a very small part of where we are now. I mean, the thing that's so stunning about this, because the comparisons obviously are going back to 2008, 2009, Washington Mutual on the consumer side, but then obviously everything that happened on Wall Street. No one has really been able to say definitively here that there was actually a liquidity problem. And SVB all yesterday, all Thursday, kept saying there isn't, except there now might be one because everyone pulled their money, right? A bank, if everyone pulls their money, that can create a liquidity problem at any bank, no matter how strong they were when they woke up in the morning. So it seems that they did make some poor risk management decisions, particularly not quite realizing that interest rates were going to rise as quickly as they did at the same time the venture capital investment and honestly tech revenue was decreasing at the rate that it did. So it seemed to have a little bit of a delta. But that said, it felt as of yesterday morning, if it raised that $2.25 billion, it would have more than covered that gap and should still be fine.
So I want to talk about the panic, and then I also want to talk about the thing that caused the problem. And I think the thing that caused the problem started before the panic, obviously. So, but it seemed to me like it was the most benign thing you could possibly do, right? Which is that they invested in some mortgage-backed securities. So how does that end up? I mean, you wouldn't imagine that that's the thing that's going to take down a bank because, it seems fairly safe. But they invested in these long durations mortgage-backed securities. And how did that lead to this panic that we're seeing now?
They basically misjudged what rates were going to be. And obviously rates have been rising for a while, as we all know. You had Jay Powell earlier this week really surprised the markets. I mean, the Dow dropped 500 points, I think, approximately after he testified in front of Congress and said rates are going to keep rising a little faster than people thought. So the market as a whole misjudged what was going to happen with interest rates. SVB was part of that. You could argue that SVB maybe was a little bit more exposed than was the average financial institution, just because as they kept getting more and more deposits, they needed to find places to put them, and they plugged a lot into mortgage-backed securities, a lot into treasuries. But again, it still doesn't, from what we know, look existential on its face, except for the fact that there was a run on deposits and everyone freaked the hell out.
Yeah, I'll have to.
This ZERP thing comes in here.
I mean, we'll get into the ZERP side of this, but I think first noting that you just called mortgage-backed securities benign, which is a very different way of phrasing it from 15 years ago. But I think that is, echoing what Dan said, that's the most interesting part of this entire story. It's essentially a duration mismatch that they invest in longer-term treasuries and mortgage-backed securities when rates were low. And then the price of all those are falling as rates go up. So then, their portfolios just aren't managed from a risk perspective well. This is not there's like a bunch of stuff going around. They invest in wineries or give lower interest mortgages to, I think they called them innovation economy influencers, but basically the founders or the VCs who are involved in their ecosystem.
That's crazy.
It is. And all of that stuff looks bad. But at the core, and it was interesting, the Wall Street Journal had a piece back in November on this, that lots of banks are exposed to this in an increasing rate environment when you don't hedge yourself properly, when you're buying longer duration assets, and when you're trying to actually manage that risk. You can get caught. Rates are rising. The value of all those securities that they invest in are decreasing. They're trying to plug those holes, but in the meantime, capital is fleeing. So on both sides, on the asset side and the liability side, the bank's getting hit from rising rates.
And I think we just lost Dan, so let me try to get him back on. But as we do, Ranjan, can you talk a little bit about what Dan was talking about in terms of these banks getting these deposits of money and needing to find riskier places in order to make money? Because I thought that was mostly just a consumer thing, but this was Silicon Valley Bank doing this, which is...
I think there's a couple of points on this. The first is, and coming back to ZERP, this is the ultimate ZERP story in the sense that in a zero interest rate environment, capital exploded. So much money needed to find a place. It found its way to Silicon Valley Bank. They're sitting on, again, their deposits increased 86% in 2021. You're sitting there as a bank risk manager. What do? Normally, you would loan that out to your clients in different ways. You'd come up with different lending products, but it was such an inflated amount to their portfolio that they started buying longer duration assets, treasuries, mortgage-backed securities. So then what you have right now on the asset side, where they're trying to actually, they own treasuries, mortgage-backed securities. As I said, rates go up, the value of those decrease because, again, people can get, higher interest rate products in a shorter duration. But then on the liability side, on the deposit side, this is where they are caught right in the middle of the tech crash. Imagine, as Dan said, you're a Series C company, you raised $100 million. Suddenly that's sitting in Silicon Valley Bank. Now you're slowly burning cash. You're unable to raise more money. So, your deposit slowly declines and declines and declines. So on the, like the actual customer deposit side, they're losing as well. So on both sides, they're getting hit. And again, this is purely just like a risk management, boring calculation type problem that they messed up.
Right, but they are solvent. So let's get to the panic side of this, right? Because it is sort of a panic that led to them declining the way they did, right? They had enough money to pay back whatever they need to. Maybe it would have taken a little bit longer, right? But, because they had this mismatch, they had a loss, they tries to raise some money to fix it. Next thing you know, everybody runs away. So Dan, can you tell us like exactly what happened in that story and how this goes from, okay, maybe a somewhat bad business decision from a bank's end to something that could be an existential threat to it? Oh, I think we lost him again. Okay, Ranjan, do you want to take that question?
Yeah. No, I think so. The most fascinating part of this, and as a person who focuses on content and communications, this was really, really bad communications. This is a textbook in how not to approach this. Again, there was definitely kind of like murmurs around about these duration mismatches and the risk that Silicon Valley Bank had on its balance sheet. But, people, the stock was not getting annihilated. It was up in January along with everything else. But then they come out with this seemingly innocuous, capital raising strategy yesterday. There's a press release. They say that they've already sold some number of treasuries and other assets at I think it was like a $1.8 billion loss. So again, none of that. Sure, it hits your profitability, your net interest margin, which for banks is what matters, but it should not cause this kind of problem. However, it did. And this is where the communication side is fascinating to me. First, biggest mistake as a bank CEO, never say stay calm. Like the last thing you ever want to have to say is stay calm. And that's exactly what they did. Even more fascinating to me is the CEO kind of alluded to, we have been there for you for many years, so be there for us now. Once you try to turn this into kind of like an emotional friendship type thing rather than just cutthroat business, you're also kind of putting yourself in a challenging situation. And then to me, kind of, I don't want to say the funnier part, but every tweet you see right now from some startup CEO saying, like, I stand with Silicon Valley Bank, I am going to keep my money here, is the worst possible thing you can do. Like, anyone who knows how social media works, if you talk about it, it will stay in the conversation and it will continue to keep people terrified. And I think that's what's happening right now. It's like anything else, the same way, what's fascinating, the same way everything went up. Low interest rates and kind of like hypercharged social media driven information flow, which is what allowed a lot of these assets and just the Silicon Valley Bank and tech startups to actually, like explode in value, is the same thing that's hitting it on the way down.
So I guess I don't understand why it's a bad thing to have people say that they stand with Silicon Valley Bank and that they're keeping their assets in there.
Oh, Streisand effect. If you talk about it, that people will, like, the worst thing you can do is continue to talk about it, especially in the context of a bank run. Because by you saying out loud, I stand with Silicon Valley Bank, we should all do the right thing together. Yeah. You're just keeping it in the conversation that it could be insolvent, that we could be in a liquidity crisis.
But could it have a liquidity crisis? And we have a question from Andy Wang here, who's watching with us on LinkedIn Live. And again, for those listening on the feed, we do these every Friday. So keep track of my LinkedIn page, and I'll put the links up there, and we'll let you know when these things are running. But we have this question from Andy Wang, who says that the problem isn't so much the duration, because the bank is expected to hold it to maturity. So they had these mortgage-backed securities. They were going to hold it for 1.75%, and then eventually they were going to be okay. The issue is the withdrawals exceeded the available cash. Now, I'm not 100% sure if this second part of the statement is what's happening, but effectively when you have everybody panic, right, then they're going to be, they would have been fine, but it's actually the run on the bank that's the problem. Because if everybody's going to go try to withdraw, then the bank inevitably won't be able to pay back. And are we at that point now, or how much attention should we be paying to this?
I mean, this is where it's Friday, 10:15 a.m. CNBC just reported that, earlier this morning, the stock was halted and it was announced that they would be trying to find a buyer. And then now it's being reported that, that Silicon Valley Bank Financial in talks to sell itself after attempts to raise capital have failed. Sources say, they're saying, but there's actually concern if you're trying to actually sell, if everyone's withdrawing their money, how do you try to price that? Imagine the poor bankers who are going to lose their weekend and who are trying to come up with the price, but have no concept of what the actual deposit side is going to look like in 24 hours, 48 hours, whatever it is.
Right. And so, Dan, first of all, welcome back.
Thank you. Hopefully we'll see how long I stay. Yeah.
So Ranjan and I have talked a little bit about what inspired, what is behind this, what the panic might lead to. Why should we be paying attention to a bank like this? I mean, it's just, okay, it's a big bank, but what about it makes this a big story?
Okay. Well, obviously, I mean, look, size does matter, right? When it comes to banks, size matters a lot. I think a couple things. One, there is at least a suggestion that this reflects kind of the health of Silicon Valley as a whole, and I don't mean the physical region, but I mean the theoretical one, kind of tech and life sciences startups. That there's something kind of more sinister is the wrong word, but that the damage that's been done there over the past year or so is deeper than people realize. But then more importantly, these are real companies. And I understand the idea, and it's been talked about a lot, and I wrote it this morning in the newsletter, that the US government, at least in our lifetimes, doesn't really like banks to truly fail in the sense of customer deposits get lost, right? Like a bank can fail, but even though the FDIC is only insuring, business accounts up to 250 grand, well, everybody will still get their money somehow. Somebody will find, they're not going to let, company X or company Y have their $5, $10, $50 million disappear. But that is a legitimate fear right now. That's our assumption. It's based on precedent, but it's not guaranteed. It's sure as hell not the law. And if you're a startup or any company that is healthy right now, who's got your money with SVB, you've got to be pretty damn scared. I mean, imagine being a company that's even a slightly profitable company or a break-even company, or God forbid, a real startup that's unprofitable right now, and all of your bank account disappears overnight. I mean, that's an extraordinary thing to possibly have happen. And you ask founders what keeps them up at night. This is never one of those things, right, but it is all of their thing right now.
So let's go with the impact on startups to begin with. Is there a potential world where startups are not going to have the money? And so this is like where all the VC money goes to startups when they've raised the money. Is there a potential world where startups are not going to have access to that cash?
I mean, by the letter of the law, sure. We're the bank to go under. And again, one thing that's really important, we still don't know how deep the withdrawals were in the last 24 hours from Silicon Valley Bank. They haven't said. We don't know. We do know that some people who've been trying to pull their money out, including this morning, some texts that are coming into me now, have not been able to do it, or it's taking hours and hours. And that might be because SVB, given what's happening, is putting kind of some higher checks and balances before they just let money go out the door. It's not like taking $20 out of an ATM, but that's adding fear. And, somebody might hear, okay, so a startup's going to struggle a little bit. Well, maybe that's payroll. This is, today's Friday. I'm guessing a lot of people pay their employees today. Mm-hmm. That's real fear. And the trickle down effects of, missing a payroll, or lots of companies, hundreds of companies, thousands of companies missing a payroll, is extraordinary.
What do you think? We were just talking about, the communications challenge that Silicon Valley Bank has. Obviously, the stay calm yesterday, not the best choice of words. Nope. What can they do right now? I mean, what would be a potentially optimal way to try to kind of stave off this panic?
I think so two things. One, they felt hamstrung yesterday by the share sale and the so-called quiet period that the SEC puts around securities offerings. And there seemed to be a feeling from SVB and from General Atlantic, who's the firm that offered, that had originally said they would put in $500 million prior to all hell breaking loose, that none of us can talk about anything material about the bank because that would violate SEC rules. I would suggest that that was a massive mistake. They should have taken the damn SEC fine eventually and covered their ass. Like there's levels of problems. This is a bigger problem than violating, a quiet period restriction. Take a fine in a year when things stabilize.
Can you talk a little bit more about what that restriction is? Is it like a 24-hour period or something?
The restriction's supposed to be that while a share sale is in process. So SVB yesterday morning, or maybe it was after market close on Wednesday, announced we're going to do the share sale. They thought they were going to get it done pretty quickly, but it had to go into market. It took a process. In theory, while a share sale, and this is true for an IPO as well, when a share sale is ongoing, you're basically supposed to keep your mouth shut. Really, what you can't do is say anything that's material or anything that's potentially forward-looking. You're basically not supposed to say anything about the business that isn't sitting in documents that have been filed with the SEC. So, you don't want to put a situation where one investor, one investor's only relying on the documents. Another one, saw you tweet something or heard you at a speech. So that was the restriction. Greg Becker, the CEO, did talk a little bit. What they, I think, need to do today is I think they need to be as transparent as humanly possible. And even if it's really bad, they probably need to say that. How much money has been withdrawn? Why are people having troubles getting the wires out? Are you for sale? I mean, this is all very uncomfortable stuff. This is nothing that anybody at SVB was expecting, very recently. This isn't like a company that's been on the brink of bankruptcy for months and finally has to rip off the bandage. But man, transparency is everything right now. And so far, they're being pretty quiet. They're continuing to be pretty quiet. If the share sale is dead, which is what CNBC is reporting this morning, then the quiet period thing is already out the window.
Right. And even CNBC this morning was reporting that they're going to sell and then maybe they're not even able to sell, what happens if they can't sell?
I mean, you could be looking at failure. I would be surprised if they can't sell. I mean, I honestly would be, if only because JP Morgan particularly has always loved Silicon Valley Bank, and not loved them as a partner, but loved them as an asset. I mean, the real asset here isn't the deposits. The real asset is the relationships that SVB bankers have with companies. And even companies, I keep hearing from companies and venture capital firms that have been pulling money or recommending that companies pull money. They still really most of them still really like the individual banker at SVB, the contact they've had for 5, 10, in some cases 20 years. And so if there was a backstop, a financial backstop, and a kind of gold-plated name like JP Morgan behind it, I think there's an argument to be made that those bankers could get that money back and could get those relationships back.
What should the tech world do here? Because obviously them tweeting that they're standing by Silicon Valley Bank, makes it seem like, there's a chance of insolvency. Them telling their startups to pull the money makes it seem like there's a chance of insolvency. If you're in the tech world, you have money in Silicon Valley Bank, or you're influencing companies that do. Are your hands just tied? What do you do?
I think a few things. I think your hands are kind of tied. I'm sympathetic to both sides of this argument, right? I am sympathetic to the side of the venture capitalists who are standing with SVB saying that, literally fear is all we have to fear, right? This is happening. This is a bank run. This isn't happening because the bank was insolvent. This is happening because you're making the bank insolvent. Stop what you're doing. I am thoroughly sympathetic to that. I am also sympathetic to the idea, though, that what they're arguably also saying to founders is take a chance, and don't take a chance with, like a new hire or maybe, something else. Take a chance with your bank account. There is nothing more precious to any company than its cash reserves. And it's a huge risk to take, because if you're a venture capitalist saying stay the course and you're wrong, the consequences for the company is catastrophic. And for your LPs, it's a really big problem too if you're the venture capital fund, but it's existential for the company. And in the end, there is not a particular reason for a company to use SVB over Chase or over First Republic. You might have better relationships, you might get slightly better rates, there's slightly better products. But in the end, what's most important is that if you raise $20 million, that you have $20 million.
Well, do you think, in terms of the contagion potential here, what's wrong with the idea that, everyone moves their money in Brex and Mercury and all these other, and Chase, and everyone else benefits. And we have a little bit of a capitalist creative destruction here, and Silicon Valley Bank made some mistakes. Could that be the outcome, and a pretty reasonable one?
It could be the outcome. On reasonability, the problem I think becomes if you're a company or let's say any institution, company, fund, et cetera, that has to put your money somewhere. What exactly do you do here? Because again, this isn't like, from what we can tell, that Silicon Valley Bank, and I hate to use this word, deserves what's happening to it, right? Like, and like it's not that, there's been a massive fraud uncovered and, oh my God, they were hiding the ball. That's not the case here. What you're hearing, I think, from the smarter venture capitalists is to their companies, diversify. Don't take all your money out of SVB and then put it into First Republic or into Chase. Put a little here, put a little there, put a little bit there, which, by the way, sucks for a startup CFO and for their accounting team, but it's probably the wisest move right now. And make sure, honestly, that you've got some in the equivalent of the mattress.
We're here on Big Technology Podcast Friday edition. Joining us is Dan Primack, who's the business editor at Axios. And as always, Ranjan Roy is here with us on Fridays. We're breaking down the week's news. And this week, the news is Silicon Valley Bank. On the other side of this break, we're going to talk a little bit more about what the implications are and also what it might mean for the Fed's campaign of rate raises that we always like to discuss on this show and how that drives the economy. All right, back right after this. And we're back here for the second half on Big Technology Podcast. Dan Primack is here. He is the business editor at Axios, and you can sign up for his terrific Pro Rata newsletter on Axios.com. Dan, I got that right, yes?
That sounds right. Or getprorata.axios.com.
Okay, there we go. And Ranjan Roy is here of Margins. You can sign up for his terrific newsletter at margins.substack.com.
Readmargins.com. Read Margins.
Okay, one of two. I won't make that mistake again, Ranjan. Thanks for listening, everyone. So it strikes me that it's kind of amazing that we're talking about the real possibility that this core bank in the heart of the tech industry may fail. I mean, it's a possibility, or at least it might capitulate in a fire sale to someone. And of course, it's its bad decision to buy these mortgage-backed securities, but it also is a product of the Fed, right? The Fed keeping rates so low that it thought that the best it could do was 1.75%. on a 10-year security. Now rates are much higher, so those securities that it bought are worth much less, and that's where that loss comes in. And there's been some discussions that maybe the Fed will keep raising rates until it breaks the system. And we talk, okay, maybe there's a possibility of contagion risk here. How do we think the Fed is thinking about this as it watches it all unfold?
I mean, there's a lot already on Twitter of some folks in the Valley, pointing the finger at Jay Powell for what's happening to SVB right now. And obviously, there's more macro news that came out this morning.
Okay, I think we lost Dan again.
I think Dan was probably going to be talking about the jobs number that came out this morning. That the job growth was beat expectations. It was 311,000, whereas expected around 225,000. So on that side, that's very hawkish. But then on the other side, average wage growth actually declined from 0.3 to 0.2%. It was lower than expectations as well. So that's disinflationary. That's a good thing, which is why I think you see the markets are all over the place this morning. They opened up, the NASDAQ was like 1.5%, I think, at the open, and now is trading down about 0.7, about 1%. So I think this is definitely a reminder that no one knows what is going on. I think our entire conversation last week was how the entire business world and economy is at a complete inflection point right now. But I do think like the idea of blaming the Fed to me is a bit ridiculous, because again, this is just straightforward the business of banking. And having sat on a trading floor in September of 2008 at Bank of America and watched it all unfold, like I think Dan had started on this point, this feels like not as bad behavior. This feels like, rather than, issuing all types of mortgage-backed securities and different tranches and selling them to clients, even though you thought they were duds. Like this is just, again, just very bad judgment on the part of Silicon Valley. And on that question of, the word deserve, I do think it's fair. And I think people need to be, understanding the fact that if you are in banking, your business is to manage this type of risk. And if you do it improperly, there will be consequences to it. And I think like every client of Silicon Valley Bank is seeing that firsthand right now. So I think trying to push the blame onto, increasing interest rates, Jay Powell, all of that, I think is definitely the wrong way to look at this.
Yeah, and I agree with that. And also, clearly, SVB is running my internet connection because I keep losing you guys. I didn't know they were in that business, but they must be in that business.
Cascading failures. Do you agree with that, Dan?
Yeah, I do agree with that. Right. This is the job of banks to deal with this. It is the job of banks to look at every possibility when it comes to things like rates. And candidly, if you're SVB, also, declining venture capital investment levels. That, by the way, is less of a surprise than the Fed continuing to raise rates, right? Like we've been talking for 12 months about venture capital investment not going away, but slowing down and valuations coming down. We've been talking, and SVB should know that better than anybody because SVB is also a lender, a venture lender. They're the ones often who are on the other side of some of these structured financings, which are really designed to help certain startups not cut their valuation, but still bring in more cash. So they're very, very attuned to the fact that there are certain, call them unicorn companies that were a little bit cash poor.
Wait, that's a great point. I mean, think about that not only do they have incredible visibility onto their deposit side, that they see better than anyone whether their clients are going to be able to continue raising money and increasing their deposits or if they're going to keep burning cash. So yeah, again, I think that's like even a worse look for them to get caught in this kind of position.
Okay, but rather than blame the Fed, doesn't this impact their ability to keep raising the rate? Because obviously it's not it's not the Fed's fault. Silicon Valley Bank did a bad job managing the risk that the Fed was, putting on them or the potential of their action. But the more that these rates go up, the more potential there is for another bank to have this situation. I mean, was Silicon Valley Bank operating that far out of the realm of normal that we don't anticipate this happening again?
Honestly, we don't necessarily know yet. And by the way, whether SVB was operating out of the range of normal or not, if this happens to another bank, in other words, if there's another run, and First Republic is the one I'll keep looking at because of what's happening to their stock price, which again has nothing to do necessarily with their investments, although they have some real estate stuff. Like if it happens to another, whether Jay Powell believes it is accurate or not that the Fed decisions, sparked this or inappropriately sparked this, he may have some pressure on him because you do not want to be running the Fed and have banks failing left and right. It's not technically their mandate to keep banks solvent, but ultimately the Fed oversees banks.
As a byproduct of your decisions, it's not what you want.
It's not a good thing, although I think we're way too early to determine whether this is going to impact the Fed.
But it had to have been paying attention yesterday when you looked. I mean, there's a tweet from Brian Sullivan from CNBC looking at all the red in terms of financial stocks. And you have, like you mentioned, First Republic down 15% yesterday. Some others like Charles Schwab down close to 9%, which isn't as bad as Silicon Valley Bank's 60% or whatever it was. But yeah, they have to be paying attention to this stuff.
Well, yeah, and then in the banking sector in general, and I'm going to try not to butcher this from reading last night, but every bank after the crisis, there's two ways that it can hold assets. Either it's hold to maturity or it's available for sale. Hold to maturity assets, you don't have to mark to market. So even if they're declining in value, you don't actually have to report that against your net income or anything. Versus available for sale, you say that these are essentially liquid. You could be moving these, selling these into the market. Those you have to mark to market. And there's definitely, a lot around how banks over the last few years, even the bigger ones, have taken on more risk or are sitting on bigger losses with hold to maturity assets. Even the Bank of America, JP Morgan, which would just be a normal part of the cycle, though. Again, not at all saying that any of those banks could be in any trouble at all. It's more just this accounting change that happened after the financial crisis to try to allow banks to operate in a slightly more stable way could be having adverse consequences right now.
Can I add one other thing that's worth noting here? SVB had a really high market cap. It was a big company. And so if it goes away, you're also talking about tens of billions of dollars of value wiped out of its investors, and some of which are big pension funds, et cetera. It's not the most important consequence of this, but it matters. There are always trickle-down effects when there is a massive collapse of something.
I see. So I'm hearing these, but I am hearing like all these things, and it's like, it doesn't really feel like it's systemic risk. And that's where I sort of...
It's except that there is contagion without an underlying, like this would almost be as if we were all sitting in a room and we all got sick. And like the CDC came in and said, we can't find anything floating in the air between you guys. You all got sick independently somehow. It's almost like we were sitting there and I started coughing and you were like, he's sick. Uh-oh, now I don't feel good. It's almost in everybody's mind, but that's real. Psychological damage is real damage.
Yeah, and I think, again, going back to 2008, I mean, I don't want to say I'm scarred from sitting on that trading floor when Lehman went under, but I can tell you that the way we were trying to manage risk at B of A that night was so uncertain. I don't want to say the entire system is built on duct tape, but there's like we were trying to understand our exposure to Lehman so we could hedge against it or offset it. And then I remember vividly, like, at 2 hours after we've already offset all our positions and gone into the market, we were missing a counterparty. There was like this old Lehman counterparty called Shearson, which was like their old name. And it screwed up all the positions, all the hedging, all the work. We had to go back into the market, cross spreads again. Like, no one knew what was going on. And you could feel the absolute kind of fear and risk of contagion there. And I think that's like what we're talking about here, is that it's something that it's hard to quantify or understand. It's just, it's as human and psychological as it gets.
This whole time we've been running up to the recession, it feels like, okay, well, or we don't even know if it's going to be a recession. It's the recession everybody predicted. We're going to have a soft landing. We're going to have a no landing. And I guess everyone's kind of held their breath thinking, okay, maybe we're going to have something that's going to, actually cause the problem, but hopefully it doesn't come. And maybe it's not this, but it sure feels like this is what it looks like.
Well, and remember, I mean, SVB is not an avatar for the entire U.S. economy. It's not even close. It's very, very specific on a certain sliver, a sliver that gets a lot more attention than do most of the other slivers. And obviously, the three of us focus on it a lot more. I mean, I don't know. I mean, I think you could make an argument that the particularly the startup sector is in recession. I mean, in the sense of, I mean, you look at the massive job losses kind of across the board. You look at revenue issues. I mean, so SVB is not. SVB, looks at U.S. national GDP, but that's not really where SVB is looking at. And that's not necessarily what impacts it as opposed to, a much more mainstream bank.
Do you guys think there's going to be a bailout for this bank? And I mean, how politically, challenging would that be to bail out the VC's bank?
I love the Bill Ackman tweet going straight to the bailout. I think that's the really interesting part of this is like, I mean, politically, the name Silicon Valley Bank is probably the worst name you could have in terms of trying to stand in front of Congress and argue for a bailout. First Republic or any of these other names are kind of innocuous and, fine. But Silicon Valley Bank, it really does represent better than anything, what would create a politically charged situation. But I honestly think, I agree with Dan. There has to be a buyer, a Goldman. Everyone wants. It's not the relationships, it's the branding. Tech isn't going away. And, this is a bank that's built its entire reputation and business around the sector. So I think, every big bank has been wanting to become more cool and techy. This is the easiest avenue that they'll ever find.
Agreed. And I think it's probably an acquisition, as it was just said. There's also the possibility of some other white knight coming in with money, a Buffett sort of person who basically just says, I'm plugging, X billion dollars into this, because if the fear here, the reason this is happening is a bank run, because everybody's worried literally they won't be able to pull their money out either ever, or at least there's going to be a disruption. If somebody like a Buffett were to come in and say, I'm putting $2 billion, $3 billion behind this company, that might calm everybody down. SVB would have a lot of work to recover what it's lost, but it could stop it from, completely burning down.
Last thing I have on this is what's the analog here? I mean, is this 2008, or how do we look at something like this and say what it is in the context of history?
I think this is uncharted territory in a nice way. It keeps us give good podcast fodder, good writing fodder. But it's this is something we haven't seen before. Again, tech sector concentrating, massive amounts of capital just in the span of the last few years and the way it did, I can't think of a real corollary there. This is definitely not 2001. I would not say it's 2008 either. So I think we're going to see like a new chapter in this. And I do think, like, again, almost a best case scenario is this just lives in the world of tech. We talk about it, but the average person never even really thinks about the name Silicon Valley Bank. And there could be a lot of wealth and value washed out, but otherwise it just stays in the world of tech.
I will say there is, though, some mainstream fascination with this, and I'll just judge this at Axios by like looking at our internal numbers on traffic for stories about Silicon Valley Bank, which I guarantee if I had written a story a week ago about Silicon Valley Bank earnings, like no one would have given a shit about it. Everybody's caring about this, so I think this is a company. And I hate to put them in the same breath because they're not at all, but it is a little bit like a Theranos or even an FTX in the sense of it has gone incredibly from a niche thing that, right, people in tech in the Valley know about to something that mainstream average Americans are suddenly learning about, and it's being discussed at dinner tables. And that matters. But I agree, this is uncharted. This is new. It's a problem. One other thing, though, that's new about this, the fissure within venture capital itself. When the dot-com crash happened, everyone felt like they were in the same boat. When COVID hit, everybody felt like they were in the same boat, for better or for worse. Even FTX, even though not everybody was invested in it, not everybody was invested in crypto, there was kind of some general commiseration. Here you have a really big split because you've got some people who feel it is their role to try to save this Silicon Valley institution, and they view their peers as the ones who are killing it, not just who are also getting hurt, but the ones who are actively responsible for the problem.
The ultimate prisoner's dilemma.
Yeah, but what is Peter Thiel's role in this? Because isn't he somebody who also, has been telling people to go to leave the bank, or is he just a flashy name that people like to toss around?
Founders is one of them. There's several, though, yesterday. So they were one of them. They are very well known, but they were hardly alone, right? You had Cotu do the same thing. I'm told you had Craft Ventures do the same thing. To be honest, I have a list of about 10, and I just haven't been able to confirm them all. A lot of firm. USV basically told people to pull a lot of their money. The information reported that. You had a lot of firms who did it. And again, it's understandable. I mean, if you've got portfolio companies and you just sent them checks, or they got checks 3 months ago, it is prudent to say, hey, there might be a run on this bank. We would like you to survive as a company. We invested in you to survive as a company. Get your money out now. So there was a lot of VC firms. Founders Fund is important, though, right? People listen to them. They've been extraordinarily successful. They're obviously, they're a little bit iconoclastic when it comes to their thinking, but there was a bunch of mainstream firms that said the same thing.
Well, I think we have a comment from Chad Elhage, who says, in secret, every fund is telling their founders to take their money and run while in public. They're saying the complete opposite. I think, Dan, you dropped earlier, but we were talking about this. Should founders and VCs make public declarations that they're standing with Silicon Valley Bank, or does that just push the conversation to the average person's dinner table? Because unless they have they're showing their bank statements, obviously the assumption could be they're just making a stand and trying to get out first. I mean,
I understand why they're doing it, right? Because the reason they're taking to Twitter is because that's the only place anyone's having these conversations en masse, right? Like there is a venture capital trade association, which hasn't said a word about this, but that's not necessarily a place where, venture capitalists all come together and then come out with a unified statement. I mean, I think it cuts both ways. I don't think they're, for anybody, those who are supporting SVB, those who are saying pull out their money, those who are saying things publicly, those who are saying things privately, I don't think there is a right answer here necessarily. I don't think there is the proper moral answer here, because on the one hand, if you really believe in SVB, I understand what people like Mark Suster, et cetera, are saying, which is, they don't deserve this. Stand with them, save this institution that's been so good to you. On the other hand, if he's wrong or there are disruptions, explain that position to the engineer, to the receptionist who can't get their paycheck in 2 weeks or even has it delayed. Well, Silicon Valley Bank was good to the Valley.
Yeah.
But I got to pay for groceries.
A ridiculous argument. People yesterday were like, Brex is now trying to take Silicon Valley Bank's customers. And people are like, people will remember how Brex behaved during this moment. I'm like, have you heard of capitalism? You're like the ultra capitalists. And a company seizing on another one's weakness and trying to recruit them as customers, to me, seems to be fall right in the rules of the game.
The only trick to this, though, is because there doesn't seem to have been fraud here. watch what happens because it could come to you quickly. There is no
Yes.
particular reason why this can't happen to anyone else, Brex or anybody else, because again, there isn't really a great fundamental reason for this.
By the way, here's a report from Newcomer right now, Eric Newcomer's newsletter. He says he's got a picture of a bunch of founders standing in front of Silicon Valley Bank, and somebody who's texting with him said there are more founders coming every minute, and that Silicon Valley Bank wouldn't let people in the building, and management threatened to call the police. I mean, that is the scene outside the bank right now.
Let's go back to something you said earlier, which is just god-awful communication by SVB. And you know what? It's not like they've got a good story to tell, right? This is not, where they come out and say, we won some award. They don't want to make a statement here. They need to. If unless they really know, and I just want to be very clear and caveat this, I don't think this is true, and I don't know this is true. Unless they're actually out of money and there's nothing left, and they're just like, they need to make a statement of some sort. It might not work, but you tell your customers something. These are your customers in a bank of every, outside of, say, a hospital. Like, this is really important.
And say something beyond stay calm, I think is, or that we've been good to you, be good to us now.
Nothing to worry about. Have you guys been reading these long Twitter threads? It seemed to me finally like Twitter Blue is kind of working. I mean, the VCs that are posting these long threads they're not even threads. They're just expanded character tweets. I found those have been pretty useful.
Well, look, there've been some that have been trying to explain basically banking, right? Which is a fairly arcane, obscure sort of thing. Some have done so better than others. And some also have gone into the whole VCs are experts on everything, whatever's important at the moment. VCs are, experts in, whether that be virology or banking.
Yeah,
but I think
stuff.
Absolutely. So. But some of them have been interesting. Yeah.
Yeah. Okay, let's end with this. This is like another blow to tech, right? We've had the decrease in valuations. We've had crypto basically go up in flames. And now we have their flagship bank, having a run on it, not to mention all the layoffs. What do all these factors combined do to the tech industry itself?
I don't know what it quote does to the tech
cumulative.
industry. I mean, it definitely reflects weakness. I think it probably, in the practical terms, it changes some behaviors, right? Definitely in terms of diversification, where people are going to hold their money, for sure. But ultimately, I don't know that this will necessarily change too much. I think the bigger issue right now for tech, or for venture capital, at least, investing in tech, is there's no way to exit companies. And at some point, limited partners are going to start screaming over this. We haven't really had a real IPO, a significant IPO in a year at this point. And with what you're seeing on the antitrust side, even though it hasn't directly gone after too many venture-backed companies, the antitrust activity, there's another thing today that the ICE is going to be blocked, or attempted to be blocked by the FTC from buying Black Knight. It is putting a chill on big tech wanting to buy small tech. And so if you're a limited partner at a venture capital fund who hasn't really gotten a distribution in months, at some point you're looking saying, how am I going to get my money if these companies can't go public and they can't get acquired? What exactly is the business model of venture capital right now? And that's a big problem, and it hasn't really hit yet, but at some point that's going to hit VC firms that start saying we need to spend a lot less. You did see in a little bit of virtue signaling, but you saw Founders Fund, in the last week, basically kind of hand back half of a fund it already raised, in part to say the opportunities aren't necessarily there right now.
Yeah, and I think that's a very good point in terms of at the macro VC level, with the IPO freeze, lack of exits, lack of options, that's obviously completely changing the model. But I do think this is a real shot to the arm here, because it's like on one side, everyone's been sitting back. They know the lack of liquidity meaning exits or IPOs or acquisitions has been slowing and has become a problem and is going to adversely affect the way venture capital works. But then suddenly you have this moment that all the money could just disappear as well. So I think if nothing else, it'll make people think a lot more about that change in the model, which everyone knows, but everyone has seemed to have been ignoring. People are still, there's still some big rounds happening. We haven't seen any major changes in public behavior, other than, as you said, like Founders Fund giving back half of their fund. But I think this really is going to accelerate people thinking about how VC has changed.
All right. Well, that'll do it for us here. Dan, thanks so much for joining. Great to have you on.
Thanks for having me. Sorry, my connection kept dropping.
No worries. It was
Silicon
great to
Valley
have you.
Bank's internet.
Yes, I know.
Who to blame.
SVB, ISP. It's not a great business. Yeah.
Exactly. Okay, Ranjan, thank you. By the way, folks, catch Ranjan and I at South by Southwest if you're there. We're going to be on March 13th, which is Monday at 2:30 p.m. at the Hilton Austin downtown, talking about whether Silicon Valley is dead. And then we'll be back in your feeds next Friday with another edition of our live Friday shows. And stay tuned for Wednesday, where I will drop my weekly flagship interview show as well. Thanks to everybody for watching. We have a very lively crew on LinkedIn today. That was awesome. And thanks to you for listening if you're here on the feed. Thanks to LinkedIn again for having me as part of your podcast network. And we will see you next time on Big Technology Podcast.